Good morning, everybody. Hope everybody has a nice lunch in front of them right now and are ready to listen to a little bit of topics about the markets and the current markets that we're in right now. I'm here. My name is Justin Vossen. I'm with Lutz Financial. I'm an advisor, and Lutz Financial, for those of you who don't know, is a registered investment advisor doing financial planning, investment management, and retirement plans, 401k. And 401k benefits for businesses around town. I'm here with Josh Jenkins, who's our Chief Investment Officer, is a partner with us as well. He writes our weekly commentary, our quarterly updates, and does a lot of our market education. So he's put together quite a few slides here today to talk about kind of what's going on currently in the market and what's changed, what's happened over time, and how we can go forward. So, you know, at the end of the day, we are not a prediction firm. We don't take a spot in the market and try to predict what's going to happen. We feel that the best thing done with that is with a client and individually planning with them to put together portfolios that provide enough liquidity, enough risk, and enough income to substantiate what they need. So this topic and this presentation is very much educational and educational only. It's not specific investment advice or specific recommendations for you. It's very topical and educational, and that's it. So we'll cover kind of where we arrived or how we've arrived at the spot we are at the markets today, kind of the investment landscape and some different things amongst different asset classes now that we're here. And then kind of hit some high-level topics on maintaining long-term disciplined approach to what we do with investments and what you do with investments going forward. So if you look at how we got here, I think that's really important. This last 5 years has seen quite a bit. We just put a few things on the timeline there and numbered it over the course of time. But this chart is the S&P 500 in black there, and then the green is the Fed funds rate moves over the course of time. So you can see at the beginning there, that rush to zero, when we get to zero Fed funds interest rates, happened to be with COVID, the snap down in the equity markets at that point in time, the subsequent recovery in 2021, and some of the things that went on there with NFTs and market foolishness and meme stocks and things like that, to the inflation reared its ugly head and the Fed having to increase interest rates fairly rapidly. So quite a bit has happened, and I think it's important context as we sit today with how the market sits and what potentially goes on and you know, all the things that could happen into the future. So with that, I'm going to let Josh take it away and kind of give a little bit more perspective.
Yeah, so I think, you know, as we sit today, one of the top stories, obviously, at least in recent weeks, has been the Fed's shift to easing monetary policy. In late September, they made the move to cut interest rates by 50 basis points to a range of 4.75 to 5%. And so what we're showing here in this graph is the Fed funds rate again, but here we're showing a lot more historical context. We're taking it back to 1950 or to the 1950s instead of just over the last 5 years. And what you can see, and Justin kind of alluded to this a little bit, but on the bottom right hand of the chart, you can see that the Fed began lifting rates in March of 2022. And when they did that, they did it at the fastest pace they've done it in about 40 years. And the reason behind that was, I think the Fed believed that they were behind the curve. In 2021, when inflation initially sort of began to emerge, I think the view was, hey, this is going to be transitory. You know, as supply chain bottlenecks ease, as the economy reopens from the pandemic lockdowns, this is going to more or less fix itself. Obviously, by the end of that year, that turned out to be not the case. And so when the Fed began to make their move, they wanted to send a pretty strong signal to the market that, hey, we are committed to returning inflation back to that 2% target. Because what you want to avoid, and some lessons that the Fed has learned over history, if inflation expectations become entrenched in market psychology, it becomes a lot harder to fight. And that's what you saw happen in the 1970s and 80s. Fed wanted to avoid that happening. So I think that's kind of what just happened, and sort of I would say, why was September the time for the Fed to make that move? And I think to kind of understand their thinking, you need to kind of take a step back. The Fed has a dual mandate that was given to them by Congress, and they need to promote maximum employment and ensure price stability. A major challenge that they have in doing that is, moving in one direction and achieving one of those mandates, you have to take an action that's going to hurt the other mandate. So if you wanted to do something, if inflation was running high and you wanted to move inflation lower, the actions that you would take would generally hurt the economy, hurt unemployment. If you wanted to spur employment and stimulate the economy, the actions you would take would generally cause inflation to rise. And so you'll hear it in the media, you'll hear Fed Chair Jerome Powell talking about it, or other Fed speakers talking about it. The Fed is looking at what they refer to as the balance of risk. At any given point in time, which one of these two mandates is presenting sort of the bigger danger to the economy in that moment? And of course, over the last couple of years, going back to 2021, inflation was clearly the bigger risk to the economy. So the Fed's actions were focused primarily on that side of the mandate. But as you can see in these two charts, we're showing the unemployment rate and we're showing the core personal consumption expenditures index, which would represent sort of the inflation mandate. The inflation's clearly moving lower. You see unemployment start to rise. Another challenge that they have is, monetary policy impacts the economy with a long and variable lag. So the Fed can't wait for inflation to hit 2%. If they do that, then it's probably going to run through that level. They're going to overshoot it, and they're going to cause undue sort of pain within the labor market. So they need to sort of time it right. Obviously, their objective is to achieve that so-called soft landing, where they're able to return price stability without throwing the economy in a recession. To do that, they kind of need to make a move early. And in reality, it's a little bit of a guessing game as to when. But I think the Fed thought that September was the right time.
So do you think that the Fed has another mandate of the stock market?
I think that the market probably thinks the Fed has another mandate, which is to maintain the stock market. There's been times where they've made moves. I think if you look back at March of 2020, they pulled out all the stops to support sort of the functioning of the market. And other times in 2022, they were pretty articulate in saying, hey, we need to get inflation under control, and we might have to do some damage to the market and the economy to do that. I don't think that they view the market as part of their mandate.
A bit of housekeeping here, and I should have mentioned it on the front end. Reagan Korsick from our marketing groups here. She's going to organize questions, and we will have time at the end for some questions. So I think there's a little chat submission that you can do that at any point in time, but we'll take them all at the end. So if you feel free to do it now, but again, we'll take questions at the end.
So thinking about monetary policy looking forward, obviously we are not in the business of making interest rate calls, but we do pay attention to kind of what's happening. And if you want to get a sense of what the expectations are for interest rates in the future, there's a couple of areas that you can look. There's market-based indicators, and then there's a variety of economic forecasts. The chart that we're looking at here is an example of a popular market-based indicator. And this comes from the CME. It's the Fed funds futures market. And basically, based on how traders are positioning with these derivatives, you can sort of infer what their expectation is for the path of interest rates. Now, I pulled this chart in the middle of last week. This is before the labor number came out on Friday. That was a big number. It was a big surprise. It moved markets. So this data that I'm showing you here in this graph is a little bit stale. But in looking this morning, I can say the market's expecting the Fed to do one more cut in November, and then one more cut in December. So 50 basis points of additional cuts this year. Prior to that labor market number coming out last week, they were actually expecting a 50 basis point cut in December. So they've sort of dialed back those expectations as we saw basically positive, strong economic data. As I mentioned, another place that you can look would be, economic forecasts, and what better economists to follow than the Fed themselves, since they're the ones that are controlling the rate. The Fed basically 4 times a year publishes something called the Summary of Economic Projections. That's the SEP. And included in that is something called the dot plot. And that's basically each of the market participants, the members of the committee, put their own individual sort of estimate of where they see rates going over the next couple of years, and then what they see the rate doing in the long run. And you can sort of take the median of those estimates and kind of view that as the Fed's expectation. And based on their last release of that report, which came out this September, the day that they cut interest rates, they're expecting 2 more cuts in 2024. Again, that's in line with the market now expects. They expect 4 more cuts in 2025. And then they have this long run expectation. Now, you might hear people in the media or Fed speakers talk about the long run. They might refer to it as R star or the neutral rate. It all means the same thing. And basically what they're getting at is if you believe high interest rates can restrict economic activity and low interest rates can stimulate economic activity, then somewhere in the middle, there must be this neutral rate that is neither restrictive or stimulative. And the Fed spends a lot of time trying to estimate that because that's essentially sort of the neutral stance. And so that number is not observable. You can guess at where it's at. It probably moves over time, but where they are right now is basically 2.75 to 3%. And this is important because as the Fed's thinking about policy, even after the cut that they just did, they're still technically in a restrictive stance, and they can cut a couple more times like that and still be restrictive. The Fed has come out and said, hey, we believe that we are going to sort of methodically and slowly move towards neutral. But hey, if we start to see an acceleration in labor market weakness, if the economy starts to look really, really weak, we can move faster. This gives you a sense of, hey, how far might they move if they want to fully pull away restriction, or how far might they move if they want to actually become stimulative. So it gives you a little bit of sense of the degree to which they can move.
So they're still being restrictive above 3%, and then anything below the 3% in their eyes is probably more accommodative where they're trying to stimulate.
That's right. And then that's, again, they don't know that that's the right level for sure. That's their best guess. There's a lot of, the Fed is constantly doing a lot of guesswork. So what does that mean for the bond market? Well, when you're talking about high quality investment grade bonds, the most of the return is going to come from the income that the bond is paying you. So if you wanted to sort of generate an expected return for the bond market, then the best place to start is, hey, what's the current yield? And that's what we're trying to illustrate here with this chart. We're graphing the relationship between yields and returns, and we're using the 5-year Treasury going all the way back to the 1960s. And what you see is with this blue line, that's the Treasury yield over time, and the green line represents the return for the next 5 years at any given point in time. So it's the current yield and the forward return. And what you can see is that's a pretty strong relationship. Returns follow what yields do. Now, as the Fed has hiked over the last couple of, a year and a half or so, interest rates today are the highest they've been in 15 to 20 years. And because interest rates or yield is what drives bond returns, I would say the expected return for bonds is the highest it's been in the last 15, 20 years. Our outlook for the bond market is the best it's ever been over the last 15 or 20 years. The Fed raising rates is, there's a little bit of short-term pain for bondholders, but, long-term, it was objectively a positive for the bond market, savers and investors.
We're not punishing savers anymore like the Fed was doing when they had the zero interest rate policy, right?
That's exactly right. It basically forced, and by design, they were forcing people to take risk, forcing people away from cash to buy those risky assets that were struggling in 2008. Okay, so what does a rate cut mean for the stock market? And the real answer is, of course, nobody knows. But I think we can look to history to get a little bit of context as to what the stock market has done in past cycles when the Fed has shifted from a restrictive monetary policy to an easing cycle. So what we're showing you here is the last 7 times that they've done that. And just to put the returns into context, this data that we're using here goes basically back to 1980. The average annual stock return over that time is about 12%. And what we see is when the Fed starts a cutting cycle for the next 1, 3, 5 years, usually that's pretty good for the stock market. Stocks return basically the average or better, but there's a couple of caveats with that. And one of them is very obvious, and that is, hey, if there's a recession that follows immediately after the rate cutting cycle, then the slowdown in economic activity, the hit to earnings for businesses, that's going to outweigh whatever the Fed is doing. And so you see in 2001 and 2007, two big recessions over the last sort of couple of decades. The stock market was very weak in response to that, regardless of what the Fed did. But again, the Fed's trying to engineer a soft landing. And I would say, looking at this historical data, if they're successful, that's probably a reason to have some degree of optimism for the stock market. The other caveat that I would throw in there is, valuation matters quite a bunch, and certain segments of the market are pretty overvalued compared to where they are historically. So with this slide, really quick, we want to just kind of set the stage, because we're going to spend a lot of the next few slides talking about valuation. And what I hope to do is demonstrate that, hey, the starting valuation, at least for long-term returns, matters quite a lot. And so what we did with these two charts is we regressed stock market returns with a valuation metric at the beginning of the period. So we're using the Shiller CAPE ratio, which is a popular valuation metric. Importantly, it has a long history. That's why we chose it here. And we regressed that starting valuation with returns over the next year and returns over the next 10 years. So this chart on the left is showing that regression over the subsequent year of returns. And that regression kind of gives us that gray bar, which is what the model would predict the return should be given the starting valuation level. And you can see the green dots, which are the actual returns. There's not a big pattern there. There's not a very strong relationship. In the near term, valuations don't really mean a lot. But that looks a lot different on the chart on the right. When you have a longer term return, and in reality, 10 years isn't really even that long of a term of a return. But as you expand that horizon out, you can see that relationship is quite a bit stronger. That gray line, that prediction, is really in line for the most part of what you see the actual returns being. So again, I think these charts really sort of provide some evidence that for long-term investors, the starting valuation, it matters a great deal.
So if you're buying expensive stocks in the near term, it doesn't matter as much, but as you get the weighing mechanism out over the long term, it is going to matter, right?
Yeah, I think I've heard you at one point say that valuation acts like gravity. You can fight it for a short amount of time, but eventually gravity is going to win out. So having set that table, let's look at some valuations. So this table right here, we're looking at a variety of equity asset classes, and we're looking at their relative valuation, relative to the U.S. market. And we're using a composite of valuation metrics. We're using price to earnings, to book, to cash flow, and to sales. And we're looking at, okay, how are each of these asset classes valued relative to the U.S. today? And how have they typically been valued relative to the U.S. kind of on average over the last 20, 25 years? And basically, if you're paying a higher price, if the valuation is higher today than it is on average, then essentially you're paying a premium to own that asset class. So when we're looking at what's at the fifth column, the premium and discount column, where you see large positive numbers highlighted red, that's showing you where you're paying a premium to own assets. So relative to the U.S. market, S&P growth, which is in and of itself a large part of the U.S. market,
S&P 500.
S&P 500 growth,
Yes.
Is very expensive relative to the U.S. market. Now, even the S&P 500, and sorry, by market, we're using the Russell 3000 as that definition. So
that's the broad market, the large and small and mid caps.
Right. So even the S&P 500 is a little bit expensive, but you have all these other asset classes that are trading at a discount, and some of them at pretty steep discounts. So, mid caps, small caps, a variety of areas internationally in emerging markets. These are all areas where you don't have to pay a premium to own them like you do with large growth. You're actually getting quite a sizable discount to own those stocks. And again, if you believe that valuation is a big time driver of returns over the long term, we might say that those are probably some areas that you want to have in your portfolio.
We're not saying we overweight or anything like that, or try to trade this. You just want to have this diversification because, again, the larger cap stocks seem to be on a relative basis a little bit more expensive and have a lower expected return at that point based on CAPE ratios and other things. And the smaller stocks, the international and the value, tend to have a little bit more discount to them, so they have a higher expected return going forward. And you can see this in this illustration when you have, large cap growth, small cap value, mid cap blend, and international up against each other. And I'll let Josh describe this a little bit more too.
Yeah, so basically here we're looking at the exact same data that we were looking at in the prior slide, but instead of looking at it sort of a cross section, a bunch of numbers on a table, we picked 4 of the different asset classes and we're viewing it as more of a time series. So how has that current valuation ebbed and flowed over time relative to what it is on average? And you can see within each one of these charts, each chart represents a different asset class. You have that middle gray bar that represents the average. And then you also have something from the previous tables where the Z-scores, that's basically a statistical measure of how far away from the average you're moving. If you're above the top blue bar, that means it's probably, statistically overvalued. If you're below the bottom blue bar, that means it's generally cheap. And you can see here again, large growth has moved above that expensive line. It actually was very expensive in 2021. We saw what happened when 2022 came in. Large growth was one of the most poor performing segments of the market. And a lot of that, I think, because of how overvalued it was. But again, as the market has snapped back, those valuations have returned. But when we look at small cap value, at mid cap blend, at international, all these areas relative to the rest of the U.S. market, they look very attractive from a valuation standpoint.
So relative basis, it's like, I think a lot of people are like, oh, the market's real expensive. We're hitting highs every day. And when you kind of look underneath the hood, it's pockets of the market are very expensive, right, relative to historical valuations, but some of these other pockets, relative valuation, are a little bit cheaper.
That's 100% right. And look, we wouldn't advocate only owning those cheap places because we prize diversification over all else. Yeah. But tilting maybe away from the expensive stuff and towards the more attractively priced stuff, that's the way to sort of capture that benefit and reduce the risk to your portfolio from those high valuations.
So for our CPE folks, Reagan's got a poll, and you have to elect your poll to make sure you're still awake and listening. And she's pulling that. It should be up on the screen. So you need to answer the question, please. Do you want to maintain that CPE? All right, hopefully everybody got that right.
All right, so, kind of continuing to talk about large growth a little bit more, there's a subset of the market that's really been driving returns over the last couple of years, and they've been dubbed the Magnificent Seven. So it's 7 companies. It's actually 8 different stocks, but they're sort of the darlings of the stock market right now. It's Microsoft, Apple, NVIDIA, Amazon, Meta, which is Facebook, Alphabet, which is Google. Of course, we're including both of the share classes there, as well as Tesla. These 8 stocks or 7 companies, again, have been leading the market for the last couple of years. They've all moved into, a couple of them have been in the top 10 for a while, but all of them over the last couple of years have moved into the top 10. And what this has done is it's made the top end of the market very highly concentrated. These 8 stocks alone comprise 31% of the S&P 500. That represents more concentration than we saw at the peak of the tech bubble. It's probably the most concentrated we've seen in the market since the early 1960s. Now, unlike the tech bubble, where a lot of those companies had nonsensical sort of business models and they weren't generating any money and they just attached .com to their name and garnered a huge multiple, these 7 businesses, they're great businesses. I mean, they're very profitable. They generate tons of revenue. They're really good businesses. The challenge is everybody knows that. Everybody wants to own them. As people sort of herd into those stocks, they're bidding up the price. And what we can kind of see, and again, this table is showing a common valuation metric, the PE ratio for all the stocks individually. We're also showing it kind of in the middle there for the Magnificent Seven. If you just took the weighted average of those 8 stocks, their PE would be a 41. If you compared that to the S&P 500, which is 27.5, or the S&P 500, which is the dark blue bar, stripping out the Mag 7 at 21.5, you can see that you're paying a massive, massive premium relative to even the other large cap stocks in the market.
Now, historically, that's PE ratio of the S&P 500 has been 16, 17.
That's exactly right. So the average over the last, say, 20, 25 years has been a 16 or 17, which is probably a little bit higher than the very, very long term, but certainly over the last 25 years.
But if you do look at the far right, there's the S&P 400 as mid caps and the S&P 600 as small caps. And those are carrying probably roughly, they always usually carry a higher PE, and they're probably roughly in line with historical.
I would say, I think 400 and 600 are probably in line with historical, maybe slightly below, but certainly somewhere around what you would call fair value. They look cheap on a relative basis. If you don't mind, go back for just 1 second. The last comment I would make is you could have the best business on the planet. If the price you have to pay to own it is too high, that business becomes a bad investment. If the price is too high, your return's not going to be that good. And when you price these things for perfection, they need to deliver perfection quarter in and quarter out. Merely great results are not enough. If you start to sort of slow down even a little bit, you're going to lose investor excitement. Some of those multiples are going to deflate, and that's going to have a negative impact on the stock price. And what we've seen historically is that tends to happen. So this is a chart that I love from Dimensional Fund Advisors. And they basically went all the way back to the 1920s, and they looked at every stock that has ever made it into the top 10 of the stock market. And they looked at, hey, what were the returns as they moved up? And then what were the returns after they got there? And these are returns relative to the market. So, you wouldn't be surprised to see that as they're getting bigger, they're dramatically outperforming the market. The 10 years, the 5 years, the 3 years before making it into the top 10, those are significant excess returns. The businesses are obviously they're good businesses. They're growing fast. They're generating a lot of investor excitement. Their multiples are expanding. This is all good for their stock price. But then they kind of make it in the top 10. And eventually, at a certain size, maintaining rapid growth becomes a lot more difficult. Things slow down, you lose some of that investor excitement. And what you see, again, over all these companies over nearly a century of history, once they kind of make it, the results moving forward aren't as good. Maybe over the next 3 years, they're in line with the market, and next 5 years are in line with the market, but over time, they tend to start underperforming the market. And I think between the other chart that we showed you that demonstrated that strong relationship between valuation and future returns, and then here actual examples of, hey, these companies, when they get this big and this expensive, they don't do very well. I think this all suggests, the Mag 7's been great. Maybe you don't want to chase them. We think, so if you want to de-emphasize the Magnificent Seven, you want to diversify your portfolio, where are some of the opportunities for good diversification? We would say international is a big one. And what we're looking at here, this is an illustration of how the global value, the global stock market, how that value is sort of spread around the different countries. And what obviously jumps off the page is the US, which comprises over 60% of the value of the entire global stock market. So you see sort of what percentage the other countries make up. Even the next biggest country, Japan, is, the US is a magnitude higher than Japan. But having said that, 40% roughly of the global equity opportunity set exists outside of our borders. And all of those countries, they have their own economies, their own monetary policies, their own currencies. All of these things cause those markets to sort of ebb and flow and march to a slightly different beat than the US drum. And when you combine those together, what tends to happen is a portfolio in aggregate that ebbs and flows a little bit less. You get that positive diversification benefit. And then add on top of that the fact that valuation outside of the US is a lot more attractive. And again, we believe that valuation matters in the long term. You're getting a diversification benefit. You're probably improving expected returns. We think international, owning that is pretty compelling as we sit here today.
I think it's interesting. This chart 10 years ago was about 50% US. So the last 10 years, the US portion of the stock market as far as value relative to the rest of the world has actually increased. And that's a lot of this due to the Mag 7 and the S&P 500 growth.
That's exactly right. Now, most countries have what's called a home bias. Basically, investors overallocate to the country in which they live. And for US investors, man, you could really forgive people to want to feel that way because, over the last 15 years or so, the US market has outperformed international pretty handily. But if you take a step back and look at a broader historical context, you can see that the relative performance of US and non-US markets tend to be cyclical over time. As we hear a lot of investors that say, God, why look at how good the US market has done. Why would I want to own anything else? We think right now the valuation of the non-US markets could provide a reason that sort of cyclicality will rotate back towards international.
If you look at some historical context too, I think one of the things that we always point to is, the last time we saw these valuations to the large cap skew higher during the dot-com crisis or dot-com bubble, I should say. The next 10 years, and this is from January 2000 to December 2009, the S&P 500 actually had negative returns. Having those diversified asset classes like international, like REITs, like small cap values, other large cap values, you actually have positive return. I mean, Russell 2000, which is a small cap index, was actually up double and change while the S&P did nothing. And it's not to say that this S&P run can't continue. I don't think we say it can't happen. The point of it is you need to diversify a little bit away from it in order to kind of capture some of those other returns when things don't perform like they have been in the history over the last 10, 15 years.
Sure. Yeah, so we're going to switch gears a little bit and kind of talk more kind of along the lines of market psychology and maybe provide a couple of our views in terms of, how should you be disciplined for the long term. But when we think about market psychology, in October of a presidential election year, I think a lot of people have the election on their mind, and a concern that we hear from a lot of clients is like, hey,
it's the number one concern of clients.
Yes. And what we hear is, what's going to happen in my portfolio if XYZ were to win? And, we like to show this chart because I think it surprises a lot of people. And that is, historically, it hasn't mattered who the president was. It hasn't mattered which party's been in power. What we've seen is the stock market and the economy thrive regardless of who's in power. And I think that occurs because, of course, the president has influence over the market and can influence the economy. So many other variables. Where are we at in the business cycle? Where are interest rates at? What's inflation doing? How's global trade? What are economic conditions outside of the U.S.? Hey, where are valuations at? Are there wars? Is there a pandemic? There's a never-ending list of variables that are influencing what's happening in the markets and the economy. That, at the end of the day, the president just doesn't have that much sort of overall influence. And
there's going to be winners and losers on either side of it, whoever gets elected company-wise. The whole point is having the diversification to have a little bit of the winners and not have to make that decision to pick one based on who's president, right?
I think that's an important point, right? Because if you look at this chart, look at the wealth that was created just by owning everything in total.
Yeah.
As opposed to trying to pick the winner may be guessing wrong, or maybe you picked the winner correctly, but the market just doesn't quite react the way that you expected. I mean, I think that's an excellent point.
Well, on the right too, I think, even in recent history, the market didn't really care who was president there either. It was really good returns because the uncertainty on who was going to be president kind of went away. And so the market could calibrate off of that and expand and grow. And, regardless, when Donald Trump was elected the first time, and then when Joe Biden was elected, the returns were very positive for both candidates.
Yeah, I think it's a big deal just knowing what the landscape's going to be, right? Once you kind of understand what cards you've been dealt, you can adapt to it, you can move on. And what I like to say is, we preach strongly that you want to separate politics from your portfolio. When you're investing, you're not betting on one political party, you're not betting on the other. You're betting on business owners. You're betting on sort of, entrepreneurism in America. You're betting on these people's ability to adapt to whatever the landscape is, whatever cards they're dealt. And 100 years of history that we're looking at here shows, man, people are pretty good at that. All right, so we can't talk about market psychology without talking about a direct measure of market psychology, and that comes through investor sentiment surveys. So here we're looking at data from the American Association of Individual Investors, and they've been doing this survey, I think, going back to like the 1980s. Basically, every week they put out a survey to individual investors, and they ask them, hey, how bullish or how bearish are you in the near term about the stock market? And what we have in this chart is going back to 2013, sort of what the answer is. You can see sort of that middle blue bar represents the average. We have a standard deviation above and below that average. If you're above the top blue line, that's kind of excessive optimism. If you're below the bottom blue line, that's kind of excessive pessimism. And that green line is extremely noisy. And the vast majority of the time, it's telling you nothing. But when the lines hit when sentiment hits an extreme, it actually is probably informative. And that's what we're trying to demonstrate with the table at the bottom. Sentiment is going to follow what has just happened in the market. So we look at stock market performance 3 months before a survey was measured. You can see that when participants are excessively pessimistic, the average return has been negative. When it's really optimistic, the return has been above average. So market performance has a huge impact on market psychology, but that also, when sentiment reaches an extreme, it's informative about what might happen in the near term. So kind of looking on the right side of that table, in the 3 months after a survey, when investors are really dour and very pessimistic, the market actually tends to deliver a higher than average return. And when optimism is excessive, the market tends to deliver a lower than average return. So it's kind of a contrarian indicator, but it's sort of a hat tip to one of those classic Buffettisms where you want to be fearful when others are greedy and greedy when others are fearful. That actually does play itself out when you look at the data. Now, we're not within our portfolios making market calls or trying to time the market based on this, but I think it does a lot to calibrate yourself for the expectations. It kind of reduces some of the surprise, and some of the pain when the market swings quite a bit.
Well, you go back to 2020 where it was low, and even 2022 where markets had a tough time for sure. Sentiment was terrible, and there was every reason at the point where sentiment was terrible that it was going to get worse. I mean, 2022, we're raising interest rates and we're going to go to a recession. So, that was the sentiment at the time, and it could have gotten worse. And the point being is it didn't. So it's easy to look back in hindsight, but you got to remember when you're there at that point too, that it's going to get better at some point, right?
Yep. So we want to talk a little bit about active management, and really the most common ways to actively manage a portfolio is through market timing and then security selection, which is just a fancy way of saying stock picking. And, we think the market is efficient enough to where even the professional investors aren't going to be able to make excess returns and outsmart the market. We certainly don't think, a typical individual investor will be able to either. But this chart, I think, provides a good example of some of the dangers that can arise when you try to time the market. And I think for individual investors, the most common sort of market timing that you see is, hey, the market just got really volatile. I'm going to get out. I'm going to wait for the dust to settle, and then I'll get back in. This chart highlights some of the risk of that. And so what we're looking at is what would happen if you invested $1,000 and had that investment from 1991 to 2021, so a 30-year period. And what you see on the bar on the far left is that initial 1,000 by the end of that 30-year holding period, 7,000. And I think that in and of itself demonstrates the tremendous wealth creating power of the stock market and the power of compounding. You could have bought an index fund and just sat there. The stock market is a powerful engine for stock market growth. Now, with these other bars, what were to happen if you got out of the market during a volatile period and you missed the best week, you missed the best month, 3 months, 6 months, or a year in the market? What would have happened to your ending wealth? And I think what is interesting is if you can see the dates that are below the sort of the green font under the bar, the dates of these best periods all fall either inside or directly next to some of the worst market environments that we've had in the last 30 years. So the best week for the stock market actually occurred in November of 2008. That is smack dab in the peak of the financial crisis. The best 1 month, 3 months, and year were all immediately followed sort of the COVID bottom. And I think what a lot of people maybe never realized or have forgotten is, the maximum drawdown coming in during COVID was probably 35%. When the market rebounded, it made up over half of those losses in just the first 3 days. There was no all clear sign that it's good to get back in the market. There was no signal that, hey, you should get back in. You almost certainly, if you had gotten out of the market to avoid the volatility, you almost certainly missed that initial phase. You probably missed a lot longer than that too, because one thing that you see is people who do sort of dump their investments and go for the safety of cash, they struggle to get back in. The other comment that I would make is, so let's say you were an investor and you were, all right, and let's say you were disciplined for 29 of the 30 years. If you missed that best year, your ending wealth wouldn't have been 27 grand, it would have been 15 grand. And again, if you're an investor and you're saving for retirement, that's late in sort of that investment horizon for you. You're never going to be able to make that up. You're never going to be able to get back up to that 27%. The risk is high when you're trying to time the market because you can definitely potentially get whipsawed around or miss out on some good periods.
It's the old adage that time in the markets is better than timing the markets. And nobody can really do that with consistent success. I think there's a lot of people out there that you get it right every once in a while, but consistent success is very rare.
Sure. When you're thinking about returns, the period with which you're compounding will make a bigger difference on your ending wealth than the return that you're earning. So the longer you could be in the market, it's an exponential function. It's going to have dramatic sort of impact on the tail end. That's market timing. Again, we caution against the temptation to do it. We recognize that when things get a little hairy, that temptation is very strong. The other area of active management that we kind of want to pick on a little bit here is stock picking. What we're looking at is data output from a famous study that Standard & Poor's does twice a year. It's called the SPIVA, and it stands for the S&P Index versus Active. So what they're showing you here are all the actively managed domestic mutual funds. What percentage of the funds underperform their benchmark over a variety of time periods? You can see the top row, we're looking at all domestic funds in aggregate, but they also go through and they slice and dice the universe of funds and categorize and group them into a variety of different groups. When we're looking at the returns, we want to focus on the longest term return because generally the longer the term, the more likely you're getting rid of some noise, maybe you're getting rid of some good luck, maybe some bad luck. It's more likely to be sort of an accurate picture of reality. So that's why we've highlighted sort of the green column, that 20-year run. That's our longest period of time to look at. But what you see is that in that top row, for all domestic funds, 94% of them underperformed their benchmark on the last 20-year run. Now, again, these are professional investors with teams of CFAs, teams of PhDs, massive amount of tools, their own trading desks. These guys make, a bajillion dollars trying to make these calls, trying to pick these stocks. 94% of them. The market is simply too efficient to think that you're going to outguess all the other sort of investors participating in the market. We think that this is pretty damning evidence against the ability to pick stocks.
So the point is, you don't have to pick the best manager to have a decent rate of return, and you can perform like the market, and that's going to be 93 to 95% of them potentially. So, our point is, you don't have to play that game to have a reasonable success. So, if there's a 95% chance that I'm going to underperform it, why would I take that? I wouldn't walk into a casino and bet on a game I have 5% chance to win.
Sure.
Yeah. So, Josh has went through a lot of things, and I think one of the things is we kind of put a bow around this from that first slide of all the things that have happened over the 5 years that we've had here with the markets hitting records, the Fed funds going to zero and then subsequently rising back to 5.5%. Over the course of that time, common knowledge or things that were assumed generally predicted by people in the market or others, or the talking heads on TV, these kind of list of things was, I think kind of people just assumed were going to happen. I think that they thought there was going to be a recession when the Fed raised interest rates. There really hasn't. The housing market was going to crash with high mortgage rates. That hasn't happened. Russia was going to go in and conquer Ukraine, and the commodities were going to soar, and then the cutoff of gas into Europe was going to freeze Europe up, and oil prices were going to shoot higher, and they're actually going down to lows. There's the point of this is that all these didn't happen. And, this is part of the reason the markets are higher. People were assuming these things and it was kind of common knowledge, and none of these things happened. Today, there's the same kind of list of assumptions, whether it be, the Israeli and Mideast conflict, or there's going to be chaos after the election, or the falling inflation's not going to stick, or, we potentially won't have as many Fed cuts, and maybe there's more persistent inflation. There's all kinds of common assumptions that are going on. And the whole point of this is, we think planning for what you can control and being disciplined, having some diversification, having a plan, a liquid portfolio that's diversified enough to handle a lot of these outcomes, because there are some common assumptions, and generally those are wrong. And what's going to change the markets, whether that be the bond markets or the stock markets or whatever, is stuff that we don't know. And stuff that occurs down the road that we haven't planned for. So having that planning up front to prepare for those and have an all-weather type of portfolio is something that we think is valuable as advisors ourselves. We think everybody deserves and needs that. And so whether that's with us or with somebody else, we think having this stuff, having that diversification is going to only benefit you in the long run. And the things that we don't know that are coming up are going to drive the market. So why try to predict it? Because generally these predictions are all really wrong. So, with that, I think we want to take some questions. Reagan's got some that have been submitted, and feel free to submit now. I think we've got about 10 minutes, here, 12 minutes roughly, that we can take some questions. And so we're happy to do so. So don't be shy. Nobody's going to know that you submitted it. Nobody else can see it. So we'll just read them off here and go from there. So
sure. The first one that we're seeing is somebody asked us to explain what the CAPE ratio is. So the CAPE was created by Robert Shiller, and you can actually, if you Google like Shiller at Yale.edu, you can see sort of this broad historical history that backs this figure. But it stands for the cyclically adjusted PE ratio. So your standard PE ratio is going to take the current price and put it over either the prior 12 months of earnings or the forecast for the next 12 months of earnings. The downside to that is the earnings. So not only is the price going to fluctuate as the market's open, but the earnings might fluctuate pretty dramatically depending on where in the business cycle you are. The cyclically adjusted PE tries to overcome that sort of weakness by saying, hey, we're going to look at 10 years of past earnings, with the idea that a 10-year period is going to encompass an entire market cycle. And so then you don't get that sort of distortion. It's you're adjusting for that cyclicality. But think of it as a PE ratio.
Somebody just asked, how do the Lutz funds balance risk and return? I think when I work with clients, I think from what we do with clients, I think it's very personal. I think everybody's got a different risk return that they can take, whether that be a function of what other job they have, if they're a business owner. I think they should take less risk on their personal side. If they're a doctor, potentially, you can take a little bit more risk because you've got that steady non-cyclical income coming from people that are obviously going to get sick. So I think it's individual to everybody. I know that sounds like a cop-out to say that, but I really truly believe that. And that's why it's just hard to say, okay, yeah, we should overweight equities or underweight bonds or overweight bonds or whatever that may be, because I think it's so personal for every person at what point they are in their career, the cash flow, how much liquidity they have, what their job is, when their retirement timeline is, and all that other fun stuff. So doing that is we allocate specific portfolios to those specific needs for those individual clients. So that risk return ratio is very, very, I would say, personal and tied to the client themselves. What is your opinion of target retirement dated funds?
I'd say when it comes to target date funds, at a very high level, they're probably pretty good, particularly if you're not super sophisticated. What most target date funds are going to deliver to you is usually a low cost but broadly diversified portfolio that has some mechanism to lower the risk over time. For most people, their investment horizon has a big impact on their risk tolerance. And so if as you're getting closer to retirement, you're reducing risk, that's probably a good thing. And again, they're usually low cost and they're usually pretty diversified. The one caveat I would have is not all target date funds are created equal, and they will have different levels of how risky are they starting out, how fast do they de-risk, and where is the ending level of risk. There's a pretty big variety in that. In our view, kind of going through some of the cash planning and some of these things with an advisor is gonna allow you to sort of target a tailored risk and return stance for you that's going to do better than a target date fund. But if you don't have an advisor, if you're just investing in your 401k and you don't really have any other advice, that's better than just sitting in cash. It's better than owning nothing but stocks right up into your retirement. It does a decent job, I would say. I don't know if you would add or contradict any of that.
Yeah, I think they're good. I think they're good in 401k plans because I see a lot of people put their investments in their 401k and never look at it for 20 years. And if you're 20 years and you're ready to retire and it hasn't gotten a little bit more conservative over that time and the market takes a dive the week before you retire, you're going to feel pretty bad about it. So the target date funds do get more conservative over time. Now, to your point, Josh, there's varying degrees of how conservative they get. So you got to know what you've got and look under the hood a little bit. But I think in general, they get huge diversification. They get a little bit more conservative as you approach retirement. But again, back to everybody's retirement's a little different as far as timing and how it looks and what percentage of their assets is that target date fund or 401k or whatnot. So I still think you got to kind of look and really examine under the hood and then how it relates to the rest of your assets. There's another question. So long time rules still apply, diversify, diversify, diversify. Stay in the market 100%. And I'd agree with half of that. I think the long time rules still do apply, and having diversification amongst different stock sectors, amongst international, amongst bonds and stocks, having a little, obviously real estate and cash and all those other things. Yeah, diversification's huge. The market 100%.
Well, that could be the stock and bond markets.
Yes.
So in that case,
don't try to time it and be in there, but have an adequate balance depending on your personal risk and things like that. So yeah, stay in the market, but you don't have to be 100% equities either, if how that reads a little. So I think it's a personal decision. Any more questions? Seem to be. Okay. Well, we appreciate everybody for joining us. Obviously reach out to Reagan or anybody at our office if you have any further questions that may be specific to you. But we really enjoyed taking the time to kind of go through where we are and where we sit in the markets and maybe some things you hadn't seen. And hopefully everybody gets a couple things out of it. And some of those slides are a little more detailed. And our goal here is to give you 3 or 4 or 5 things that maybe you hadn't thought about. And maybe as it pertains to you, you go back to your advisor and go back to your family and discuss things. So appreciate everybody joining us and wish you luck and enjoy the rest of the week. Thank you, guys.
Thanks.